Deep Dive with David Stendahl, where we trade without ego, no emotion, no greed, and no opinion. Before we begin tonight's video blog, please read over our trading disclaimer and remember to trade smart and accept the reality that trading futures is risky. This presentation does not provide buy-sell recommendations, and our information is strictly provided for educational purposes only. As always, trade at your own risk and analysis. Hey there, it's David Stendahl with tonight's Deep Dive. It is May 15th, 2019. Thought I'd take a look at the S&P 500. The SPY is the ETF that you'd want to look at. And the reason I'm looking at this is that we've come down to a particular point, and with the last couple of days action, there's been a bit of a pivot, and we're at a kind of a critical point. So let's go through some of the numbers and get a feel for what's taking place. So here are the trends here, specifically for the S&P 500. You can see that they're mixed. We have the technical rating, which is actually positive. We've got the seasonals, which we'll spend some time on, which is also positive, but we have a support gap. And so that is weighing out there, and what that means is that if the support that we're going to be talking about tonight doesn't hold, then there's some downside action to the market. So with that, we'll also look at some of the different patterns where just recently, the last trading day, we had a surge low, which was basically a profit taking for the shorts that were out there and was looking for a bit of a reversal. And then we had a dazed, which occurred 2 trading days ago, which is more of an official reversal type indicator. So you can see profit taking at the top here and reversal here down at the bottom, or at the top up here. So what we're looking at is we've had a couple of different indicators that have popped up just recently. Now, what we want to do is look at what has taken place. So this is a daily bar for that of the S&P 500, and you can see that the market has come down. Now, it broke the 50-day moving average, but never touched the 200-day moving average. And what I was looking for was a point where the market was really going to be coming down to a particular point. So I put out on Twitter when the market was selling off that the market would probably target 28.1575. Now, it actually went down to 2800, so we were off by 15 points. But the market sold off, and we were looking for some type of a reversal and some type of a basing to the market. Now, what we want to do in this case is keep tabs on that number, that level, 28.15, because what we want to do is just simply make sure that the market really doesn't fall on a closing bar basis below that particular level. Now we have the 200-day moving average, and then we have a support level that's down here. So there's still things that can catch the market, but it's that 28.1575 level that is most interesting to me. Now, the way that the market came down at base and started to rally, that's basically what was taking place here. And what we're looking now is that in the last bar or 2 bars, we are looking at some of those deep dive alerts that did trigger this little pop to the market. I also want to take a look at the weeklies, because this tells a slightly different story. Here are the weekly bars for the S&P 500. We have sold off based upon these resistance levels, and we're now below each of these resistance levels. And when you look at the weeklies, there's really nothing to capture this. So you really need to be looking at the daily bars in order to get an idea as to where the market will have some form of support. And we'll see as to whether or not, based on the daily bars, that we're actually able to hold this support, or is the market really going to start to sell off? On a weekly bars, we've got a wave high that's triggered, which is bearish for the market. You know, if we go all the way to the top there, you can see that it pegged the top fairly well. And what we're looking for is a sell-off in this particular case on the weekly bars. But the daily bars obviously are telling us a slightly different story, and it's more of a cautionary tale more than anything else. I'm going to flip back to the website, and what I want to do is I want to show you the seasonals to get a perspective as to what's taking place. So the S&P is at least listed on the top 10. It's not the highest one, but it is at least on the top 10 list. And when we look at the 5, the 10, the 15-year seasonal tendencies to the market, there's no arrow here, but we're basically in mid-May here. So you can see that it's kind of hard to see, I suppose, but the red and the blue line, they represent the 5 and the 10-year seasonal tendencies. The green represents the 15 year. So for the 5 and the 10s, mid-May, you'd be looking for a bit of a bounce to the market, at least up until the latter part of June. So for the next month or so, a little bit of a bias to the upside. When we look at the 15 year, you can see a bounce coming up a little bit further into May, and then more of a sideways consolidation, and then a pretty rapid sell-off here. So for the most part, what we want to see is, if there's going to be a bounce, we'll see a bounce up until sometime in June, and then expect a little bit of a sell-off, and then another surge coming into, we'll just call it early July, and be able to have an advantage to take place there. So any type of a movement that we're going to be seeing in the S&P 500, I believe that it could be short-lived, it's going to be volatile, and that the next major little trend that we're going to be looking for is going to be headed in the end of June going into July. So if we pounce back here at the stock market with the S&P 500, any type of a little surge that we're going to have will be more of a tradable surge. And if the market's going to sell off, like I was talking about with the weekly bars not having any real support to the market, and all the gyrations that are going on with tariffs with China, and the talk of Iran, and some of the things that are taking place there, that it's conceivable that we could see, based on the weekly bars, a major sell-off here. But for our purposes, I'd say that, and just simply looking at the seasonal tendencies to the market, expect a bias to the upside. But if you, again, looking at the 15 years, it's going to be short-lived, and then there's going to be just more of a sideways consolidation in some of these phases. So don't have high expectations for any type of a legitimate trading opportunity. It's not going to be the type that you're going to be able to stay in like you normally would with the S&P for weeks on end. It's going to be definitely a tradable opportunity. And with that, I just want to point this out. This is our underwater volume index chart. I'll just show you where you can find this. You come down to performance, then UVI, which just stands for underwater volume index analysis. You pull up the S&P 500. The reddish pinkish hue that we see right here, this is the drawdown that we're in since we recently hit a high on the S&P futures, and we're only down call it 2.5, let's see, what is it, 3.67%. That's what the drawdown is at the current time, and it's kind of what I term as to be normal drawdown, where you can see some normal drawdowns we've had in the past. These little phases right through here, these are a little more abnormal, and we're looking at slightly higher. And we're not talking about something that's like the 50% type drawdowns, but we are looking at in and around the 8-9%, probably closer to 9%. And then we had another one that was short-lived, but was down around 17%. And this is just simply going back, over the last 3 years. Obviously, there were bigger drawdowns. But the point being is that we're in a drawdown right now, which is quote-unquote a normal drawdown. And what you want to be able to be watching this, if you're looking at the daily bars, we should bounce and get some type of a tradable opportunity, which is obviously underway right now. If for some reason we're not able to hold that support level that I was talking about, then in that particular instance, the weekly bars will probably take hold, and we could be going from normal drawdown to something that might be a little more substantial. So long story short, watch the systems more than anything else here, because the systems themselves are going to be able to take advantage of what's going to take place, and the systems at the present time are actually flat the market. So for those of you that are trading right now, watch and keep tabs on those markets as closely as you possibly can, because anything that we're going to have is going to be a pop to the market that would last for a relatively short period of time, sideways consolidation, a little bit of a sell-off in theory, based on the seasonal charts, that your next trending phase won't be happening until late June, call it July 1st. So for the time being, just simply watch the markets, watch them very carefully, watch the system, see how they react, and then have a hair trigger to get in and get out and take advantage of anything that's going to pop up or down, but anything that's going to pop up, and put yourself in a position you can take full advantage of things, but don't marry anything and have a hair trigger to get rid of some of those positions should you take advantage of any of these little pops to the market. So with that, we will take a look at another market here shortly, and we'll go from there. Bye-bye.